Ben Franklin said, "A penny saved is a penny earned." And that saying has come a long ways. It basically means that money that you don't spend goes directly into your pocket. And that's a good thing, right? Well, maybe. It depends on your situation. Growing up, my family didn't have a whole lot of money. To my dad, saving was essential to making ends meet. I remember he would fight for pennies back at the grocery store for incorrect prices on the receipt. He did what he had to do. And if you're watching this, Dad, I'm really proud of you. But my point is this: in his mind, saving was the best way to get ahead. But it's not just about saving money, is it? There's a whole other side to securing yourself financially. And it's the exact opposite of saving. Yeah, it's spending. And not just spending, but investing. The expectation of getting more in return than what you put in. Now, I'm not going to tell you how to spend your hard-earned money. You can do whatever it is you please. However, through this course, I want to reshape the way you think, your integral philosophy on spending money. You're very capable of financial growth and success. Whether you make $100 a month or $10,000, everyone's road is different. But you have it in you to gain financial success. You simply have to think about how to get the most out of every single dollar. But it all comes down to one thing: respecting the time value of money. You'll hear me say it over and over again: the time value of money. So, this course isn't just meant for business owners or CXOs or key stakeholders on boards of companies. Even if you're a 9-to-5er who's rethinking investment strategy, or someone who's simply trying to figure out how to make better monetary decisions, you will benefit from this course. My name is Yash Patel, and I love helping people define their financial philosophies and saving habits. Welcome to my course on investment evaluation. Before you delve into this course, you may want to know the requirements. Well, you don't need to be a business entrepreneur or have a bunch of stocks and bonds to follow along with this course. You do need a willingness to think about money as more than what's just in front of you. It's not just a dollar bill. It has the potential to be so much more if used wisely. My examples are couched in business practicality, but the underlying principles are essential to everyday finance. This is the kind of stuff that'll get you to think about how and where you spend your money. There's a bit of math involved in this course. However, a spreadsheet program will make life easy for you. On a technical note, if you want to follow along with my spreadsheets and exercise files, you'll need Microsoft Excel. I've also included a handout with this course that includes all the major formulas and Excel functions that correlate with those formulas. There are challenges and solutions embedded throughout the course to help you practice the procedural knowledge that you've learned. You'll also find assessment questions at the end of each chapter to review conceptual knowledge. I have a bit of a real-life aspect of this course as well, as I'll be talking with business owner Kevin Paffrath about his investment philosophy. One final note: if you're already familiar with what an investment is and its different components, feel free to skip the first 3 videos of the next chapter. Okay, enough talk. Let's get going with the course. At a surface level, the concept of an investment is easy to grasp. An investment is a purchase you make hoping to get a profit later on down the road. That's easy to understand. But there are also several components to an investment, specifically time, capital, and profitability. Time is the period that you should expect to hold an investment. You might have heard this referred to as the time horizon. Time horizon can last from seconds for day traders to years for those taking the long-term approach. The time horizon you have is purely dependent on your situation and your risk tolerance. For example, if you're a 70-year-old retiree, your time horizon and risk tolerance are going to be much lower than a 24-year-old who's just entered the workforce. The rationale for that is that market trends shift over time, but ultimately, if you hold the investment long enough, it'll pay out profitably. As you can imagine, a retiree has a much shorter time window and doesn't want to see short-term losses as the money might be needed sooner. A younger individual can wait out market forces to liquidate later on and still see profit. Of course, age isn't the only reason one may have a short time horizon. Recently, I purchased a new home and needed to sell stock to make a down payment. So I too had a short time in the market. It's an unfortunate situation, but we all have to deal with it on occasion. The second component is capital. That's essentially the financial value of assets. You can think of it as monetary funds. It can also refer to tangible items such as plant, property, and equipment. That's pretty easy, right? The only caveat is that in order to be categorized as capital, the goods or money have to continuously provide a service to the business, whether that's paying salaries or purchasing assets that create value. So, how does this fit in with the investment component? Well, when you invest, you're making a capital investment. You're helping a company or product reach its business goals by giving it money. Last but definitely not least, we have profitability. A quick definition of the term answers the question, how much money am I going to make? Most people would say this is the most important part of an investment. Before you invest in a business or goods or people, you have to ask yourself if the investment will result in a profit. Always optimize your investment to have the highest ROI or return on investment possible. Again, only 3 basic components, but investing is a lot more nuanced. However, keep in mind, if you're making business decisions regarding investment, be sure to think about how much time the investment needs to see a return, how much capital you're going to use in the investment that you could potentially use for other things, and what kind of profit you expect to see when you get the return. All right, you get it. Investments can be a good thing, especially when you get a good return. But how do you know when you're ready to invest? If we're talking about personal finance, then maybe it has to do with how much risk you're willing to take. If you're willing to invest money, you also have to be willing to lose it. It's a gamble, and the future is quite difficult to predict. However, if historical data hold up, then you'll end up ahead if you hold on to the investment long enough, regardless of market fluctuation. So how do you know when you're ready to make business investments? Well, if your business is growing at a fast rate and you can't support it with your current infrastructure, you got to start spending some money. This may include plant, property, and equipment, hiring extra staff, or buying more inventory. But keep in mind that this is all a balancing act. In order to finance these extra purchases, you'll more than likely be taking out loans at a certain percentage or giving out equity. So your return percentage must be greater than the interest that you're paying the bank in the long run. Let's be real. Even without any math, you can intuitively figure out what investments may be best for your business. You don't need to buy a Ferrari as a company car. Likewise, you probably shouldn't invest all your liquid in a volatile cryptocurrency because you're FOMOing. That's the fear of missing out. You have to diversify your investment portfolio, seek long-term returns, and do the math on potential profitability for each long-term investment. I know, sounds intimidating, right? It was for me at first too, but hey, this course can help with that. Something else you have to consider are your liquid assets. All businesses want the highest return on their dime. This is impossible given the timing of expenditures and costs. That being the case, businesses should maintain economic capital. Economic capital is all the money that's kept in banks, spare cash, or anything else that may be liquidated immediately for cash requirements. So, any money kept in economic capital should not be invested. You may be tempted to invest more money than is prudent to maximize rate of returns, but that's just a temptation that you have to avoid. For example, as I write this course, 1 Bitcoin is valued at almost 20,000 US dollars. Imagine if you blew all your cash in that investment and it dropped to even 10,000 US dollars per Bitcoin. That would be an issue. Inventory includes all the assets that are going to be sales, including finished products, works in progress, and raw materials. Work in progress items have been started but aren't yet completed, and raw materials are those that haven't even begun to be processed. A lot of liquid can go into raw materials. You really don't want to overspend on inventory as that'll eat up funds. Think about it. The actual inventory costs money and you have to pay to store it somewhere. And we're all kind of guilty on this on some level, right? I know that I always buy way too many groceries in anticipation of upcoming weeks and watch half the stuff go bad in my fridge. In this course, I'll show you a technique called NPV, or net present value, that can help you determine how to best increase your return on inventory. That way, your business can free up liquid assets to generate returns and also reduce opportunity costs associated with liquid. So, the big takeaways from this video are: you should start investing more if your business needs it. Don't wait around for your infrastructure to crumble. Seek out loans or other support. Also, don't burn through your economic capital for the sake of investing. You may need that cash for emergency situations. Most commonly for people, these reasons are tax related. Finally, think about your inventory. Don't buy up too much before you need it. You'll burn through cash and you'll have to pay to store it somewhere. Do the math to make sure you don't burden yourself in the future. So you have some money that you can invest. The inventory is taken care of, you've built up some economic capital for a rainy day, and you're ready to scale up your business. Well, there are definitely things you can invest in. First and foremost, think of plant, property, and equipment, or PP&E. These are items that help you in production. Maybe it's a more efficient tractor that breaks down less, or more powerful boosters for your SpaceX rocket. Any improvement that will increase production rate and attract investors is a worthwhile investment. Super profitable. However, keep in mind that assets generally lose value over time, so you won't be able to sell an asset at the same price you bought it for. You can also buy real estate, especially if you're looking to expand services, locations, or inventory. I love real estate. It's one of the only assets that appreciates over time. So you can hold on to it, milk it for a home equity line of credit, or as a rental property, and then sell it for higher than what you bought it for. There are, of course, exceptions to all this. I know we still all cringe when thinking about that crash in the late 2000s. You can also buy stock. These are literally certificates that say you own a portion of a company. When you buy stock, you have a right to a portion of the company's value or right to carry out a specific action. Usually, companies with excess capital or liquid will try to buy back shares of their own company to control the board or have majority sharehold of the stock. Generally speaking, stock shares tend to increase in value over time and are considered a decent long-term investment. You can also invest in projects that can help your business grow. That's going to be the real focus of this course. By projects, I mean deals that will make your business money. Whether it's a construction job where you're renovating buildings, or a job where you're doing people's tax returns. These are the services that will make your business money. Projects require a lot of overhead in terms of labor, supplies, and most importantly, time. And oftentimes your client won't pay you until the project's even over. So you're basically working on borrowed time and at a profit loss. So you have to ascertain ROI before moving forward with a project, or at least get a handle on what kind of profit you'll be looking to make. What I have provided is not an exhaustive list by any means, but I also want to get to the point. My goal is to show you different ways to think about your projects and how to get the most bang for your buck, for your effort, and for your time. The topic of this video is opportunity cost. Think about that phrase. Yeah, opportunities will cost you something. And maybe you're thinking, this instructor is crazy. Opportunities simply require hard work. Yeah, that's right. Many of them do. And they also require something way more costly, your time. If I can get you to come out with just one key understanding or takeaway from this course, it's this. Your time is the most valuable asset that you have. When you're evaluating what to spend your money on, always keep the idea of time in the forefront. Why? Because you'll have to give up time to achieve your goal or realize the investment that you're putting your money into. Let me give you a simple example of opportunity cost, and before I start, a little disclaimer. I am all in for going to college because I believe it provides more than just an academic education. So let's start with the example. Now imagine 18-year-old me, head full of hair, not a care in the world, and I'm faced with a decision to make. My parents don't have a whole lot of money to send me to college, so I can either get loans to go to a 4-year school and get a degree, or I can join the workforce using whatever skill set I have. This is a very simplified thought experiment. Imagine that if I choose to go to college, I have to start paying interest on the money that I borrow right away. So let's break down what this would look like financially year over year. Let's say I choose the college route. With interest and principal for the loan, I pay $15,000 a year for 4 years, resulting in a deficit of $60,000 at the end of those 4 years. If I choose a job, let's say I make an average of $25,000 for 4 years, resulting in an increase of $100,000, not counting taxes. So, the opportunity cost of going to college over working straight out of high school is $100,000 that I'll make at my job and the $60,000 of loans that I have to pay back, which is a total of $160,000. Now, there's a whole other philosophical argument of whether college is the right choice, but that's a different story altogether. What about the opportunity cost of starting out in the workforce at 18 instead of going to college? Let's look at it the opposite way. Well, it's difficult to monetize that, even though many people do try. Let's just leave it at foregoing the opportunity for higher education and making potential business connections. So my point is, opportunity cost doesn't have to be just about money. It can also be about intangible things. I'll give you another example that I just went through, and this is one that a lot of people struggle with. I was in escrow for a new house and trying to decide how much money to put down for the down payment. If I put down less than 20%, I have to pay mortgage insurance, also known as PMI, for at least 2 years. If I put down 20% or more, I can avoid the PMI. So that seems simple, right? Just put down the 20% if I have it, right? Well, that's not so easy. If I put down 20% and blow through the majority of my savings, I might miss out on a great investment property or opportunity in the future. Imagine that I just put down 10% and invest my other 10% in the market. I could potentially get a higher return in the market over that 2-year period than I would lose money paying the PMI. So the opportunity cost for putting down 20% is the ability to invest that money into a market where I could see much higher returns. So why do people put down 20% then? Well, sometimes they can't qualify for a bigger loan or don't see the point in paying a PMI. The opportunity cost is easy to swallow if you like low-risk scenarios and if the alternative investment involves volatility. For example, with the stock market. So here's my point. Whenever you're presented with 2 reasonable options, the choice is never clear-cut. You have to examine the opportunity cost to determine the best possible outcome for your investment. And that investment can be time, money, or both. Y'all, let's face it. Time is money. I think so highly of that cliche turn of phrase. I will park in the farthest away, readily available parking spot instead of waiting for a spot closer to the store. Why? Well, because I'm able-bodied and my time is more valuable to me than waiting for a close-to-store parking spot. Now, you don't have to be an extremist like me, but you should definitely understand the idea behind the time value of money when it comes to investment. Know that money that you currently have is worth more than the same amount of money in the future. In so many ways, the biggest loss of money you'll incur is due to loss of time. Why? Well, because if you don't put your money to work, it's just going to sit there and it's going to cost you big. People, corporations, big banks, they all want your money and they're willing to pay you to borrow it. Let's take a minute now to think about the concept of the time value of money. One of the reasons it's so important to calculate free cash flows is that $1 received today is worth more than $1 received a year from now. Why would that be? Well, there are a few reasons. First, opportunity cost. $1 received today can be invested in other projects that'll make more money. If the dollar isn't received until a later date, the potential return on investment is forfeited. Next, most economies experience inflation, meaning that the purchasing power of its currency is diminishing over time. What $1 can buy today is much less than what it could, say, 50 years ago. Finally, the dollar received in the future is less certain. The more time between now and when the dollar will be received, the more likely it is that something will happen that will result in the dollar not being transferred. For example, the person who owes you the dollar could go bankrupt or, just change his mind about paying you back. So you better get that money as quickly as you can. Simply put, there's more value associated with the dollar being received sooner. Let me give you a classic example. Would you be interested in getting $1,000 now or the promise of $1,000 a year from now? Well, I guess if you're looking to purchase that new big screen TV, then you want it right now. But what if you're looking to invest it? well, you'd still want it right now. Let's say you take that money and invest in a bond that pays 5% annual interest. 1 year from now, you'd have $1,050. That's a $50 increase. And you didn't have to do anything to earn it, except loan your money to someone else and accept the risk that they may not pay you back. But what happens if instead of receiving the $1,000 today, you receive the promise that you will get those $1,000 1 year from now? In this situation, you'd find yourself forfeiting the $50 you could have earned if you had the money sooner, and you would still face the risk of not being paid the $1,000 you're being promised. I guess you could make the argument that if interest rates increase, the bond would decrease in value and then you have to deal with the market volatility and all that stress. But that's a different story altogether. Time in the market is far superior to timing the market, and don't you forget it. This scenario also brings about some terminology that's quite useful. The $1,000 you get now, it has a nominal value of $1,000. That's its face value. The real value, given the 5% interest growth a year from now, is $1,050. The real value will increase if the discount rate, which is just another term for interest, stays steady at 5% year over year. Let me teach you a fun trick to illustrate the power of time. It's called the Rule of 72. The rule basically says to divide 72 by the interest rate to determine how long it takes you to double your principal. It's not exact, but it gives you a good approximation. So, if we have a 5% interest rate on our $1,000, we would have about $2,000 in 14.4 years. And that's just on a simple bond. Imagine if you have an average return of 8% in the stock market on even more money. Even with just $1,000, you double it in 9 years. So, would you rather have $1,000 now or the promise of $2,000 9 years from now? That was a super cool ending to my video. But unfortunately, I have to say one more thing. That average return is not promised, and markets can be volatile. But historically speaking, your investment will appreciate in the market over the long term. And that's what everyone counts on when they invest. Let's start with a basic understanding of monetary value. When selecting whether a project is worth your effort and money, it's important to determine the present value of that investment. For example, imagine that you have an investment opportunity from which you'll get $2,000 a year from now and another $2,000 2 years from now. Now, imagine that the discount rate is 4%. How much would you be willing to pay for this particular investment right now? How much is that investment worth to you currently? Remember, the $2,000 in 2 years has a much lower real value right now. That's why we're applying that discount rate, basically to account for inflation. And you have 2 pay periods, one in 1 year and the other in 2 years. So, what's the $2,000 in the future worth right now? Here's what the equation for the calculation for present value looks like, where FV is the future value, I is the discount rate, and N is the number of years. So it looks like you're going to have to bust out that calculator to figure out how much that money is worth currently, right? Nope, not yet. Let's not get into that right now. I'll just quickly show you this calculation in Excel. We can use something called the present value function. Simply pass the arguments for the rate, which is 4% or 0.04, the number of periods, which is 2, and the amount to be discounted. This is the $2,000. Now, when I press return, I'll get a negative value of approximately $3,772. That means that if I were to invest $3,772 into this opportunity right now, I would break even once I get my second payment of $2,000, given the discount rate and the payment structure. Another way to think about it is that you're going to be indifferent on whether you get $3,772 now or the promised cash flows of $2,000 over 2 years. And that makes sense. The present value of $3,772 should be lower than the promised future value of $4,000 due to the interest rate. Analogous to the present value, we can also calculate future value in an identical way. However, we need a little bit of different information. This time, we need the initial investment, the interest rate, and the number of years in the future we're looking ahead to. The formula looks like this, where FV is the future value, capital I is the initial investment, lowercase I is the interest rate, and N is the number of years. The capital I is essentially the same as the present value. I want to point out here that we're using interest rate instead of discount rate because we're appreciating the present value, not discounting a future value. Now imagine that you want to invest $1,000 in a bond that matures in 2 years at a 5% interest rate. You'd simply plug those numbers into the formula. At the end of 2 years, you'd end up with $1,102.50. With that kind of return, you might want to rethink the investment if you have other opportunities. A couple of things to notice about the future value calculation. For a constant number of years in which the investment compounds, the future value is directly correlated with the interest rate. Also, for a given constant interest rate, a larger number of years for the investment is directly correlated with the future value. Once again, we see that time in the market is generally a better strategy than trying to time the market. The third type of value to consider is a terminal value. This is how we can account for cash flows that extend indefinitely into the future. In other words, this is how we determine the present value of an amount in perpetuity. With some projects, we can expect cash flows for many years, and it's not practical to determine cash flows year over year over year. For this type of situation, we can use the Gordon growth model. Again, this model assumes that growth will remain steady indefinitely. So you should really only use the Gordon growth model to evaluate present value once the cash flows are expected to stabilize, not during volatile times. In periods of high growth or expected fluctuations, businesses should project the cash flows on a yearly basis only. It is worth noticing that since this equation gives us the present value of the cash flows as the end of our forecast, we still need to discount the value back to the beginning of our forecast using the present value technique. Let's do a quick example. Imagine that you're considering investing in a new project with an infinite cash flow life. You're able to forecast the first 3 years, and they look like this. After year 3, the cash flow growth rate is predicted to stabilize at about 1% growth. The discount rate is 4%. What would you determine the terminal value of the project to be at the beginning of year 4? Well, we know the cash flow will stabilize at $3,000 after year 3, and we can expect it to grow at 1% for the cash flow of year 4. So that's a simple calculation. It's $3,000 times 1.01, which equals $3,030. Let's go back to the Gordon growth model and plug in that value for the numerator. The denominator is simply 4% minus 1%, leaving us with a decimal value of 0.03. When I do the arithmetic, I'm left with a present value of $101,000. Theoretically, that means I can invest up to that much money up front without going into the red with this particular project. Look at what we have here. A way to calculate present value of a future promise, another way to calculate the future value of something we have currently, and yet another way in which to calculate the present value of something that may provide us riches forever. Is this comprehensive? Of course not. However, it's a good start when you're thinking about making investments. In this challenge, I'll present you with 3 different datasets. You can find these datasets in 0107 Challenge 1 in the exercise files. Your mission, should you choose to accept it, is to calculate the future value from dataset 1, the present value from dataset 2, and the present value of infinite cash flows from dataset 3. Let's dive in and take a look. Dataset 1 is a simple stock calculation. Let's take the present value and determine a future value in a period of 6 years down the road. The discount rate is 12%, which is feasible if the market has a bullish run. Dataset 2 asks you to calculate the present value given a future value. Imagine that you lease a piece of equipment for 20 years at an annual rental fee of $10,000 per year. The discount rate is 8%. What is the present value of the piece of equipment? This one's a bit complicated to do by hand, so I suggest you use the handy-dandy Excel function. Dataset 3 shows the cash flow for a project that is expected to have an infinite lifespan. The first 4 years are projected, and after year 4, the annual cash flow is expected to stabilize at about 2.5% growth. Imagine that the discount rate is 4.5%. This challenge should take you about 5 minutes if you're using Excel. Good luck! Alright, welcome to your first solution video. If you want the solution data, you can find it in 0108 Solution 1 of the exercise files. Let's start by taking a look at the first data set in which we're trying to determine future value. And what I'm going to do is I'm actually going to use the formula that I provided right here and solve it using that instead of the Excel function. So if I'm looking for future value, I've got an initial investment of $20,000. That's equal to my I. My discount rate or my interest rate is 12%. So that's my lowercase I. And my number of years is 6, which is going to be that N right there. So let me type all this into the future value box in cell B7. So that's equal to my initial investment, which is B3. And that's going to be multiplied by 1 plus my interest rate. And that interest rate should be in decimal form. So 1.12 is going to be the sum there. And I'm going to take that to the power of 6 because that's how many number of years we have in the term. So when I do that, I get this ugly number, and I'm going to reformat it using Command 1 on the Mac, or it's Control 1 on PC. And under currency, I want 0 decimal places, and that's going to look a heck of a lot cleaner, so basically $40,000. And I have something here that tells you how much time it takes to double your principal. In this case, we have an interest rate of 12, so what I would do is I would take 72 and then divide that by 12, which gives me 6. So that makes a lot of sense, right? If we have 6 years that go by and I invest an initial $20,000, then at the end of the 6 years, I should have about $40,000 given the 12% interest rate. So that works out really nicely. Let's move on to data set 2. Here, I'm trying to determine the present value of combined rental payments. Let's use the Excel provided function instead. So in cell B7, I'm going to type in equals PV because I'm trying to determine present value. And it's going to ask me for my rate, which is 8%. So I'll click on B5, comma, my number of periods, which is 20, and that's B3, comma, and my initial payment, which is $10,000. And I'm going to close that out, hit enter, and it looks like I have a present value of $98,181.47. So let me reformat this a little bit to give it 0 decimal places, and I want my negative numbers to look like this. So I'll press OK. So what does that negative $98,000 mean? Well, it means that given the discount rate on your investment, you should be willing to pay a max of about $98,000 right now to procure a piece of equipment that's going to provide a rental income of $10,000 over the next 20 years. Now, let's look at the final data set. In this data set, I'm searching for a terminal value in cell B9. And the relevant formula I provided here is a Gordon growth model. So the first thing I want to do is figure out my cash flow in the final year of projection. That's the numerator. So let me go ahead and type in year 5 here, and it automatically italicizes it for me. That was nice. And what I'm going to do is I know that I have a stabilized growth rate of 2.5%. That means my $1,300 is going to be 2.5% more in year 5. So I'll type in equals and then click on E4, which will get the 1,300 in there for me. And I'm going to multiply that by 1.025. And that'll give me a value of 1332.50. So my value increased in year 5 by about $32.50. Okay, so I have the terminal value, so I have the numerator. So in cell B9, I'll type in equals, click on cell F4, and I'm going to divide that value by my discount rate, which is 4.5%, minus my growth rate, which is 2.5%. Close this off, hit enter, and I'm going to reformat that to look like currency. So that means that if you were to continue this trend over X amount of years, however many years infinitely, this opportunity would be worth about $66,625. If you were able to follow along with all my calculations, that's great. If you weren't, please rewatch the video about present, future, and terminal values. Otherwise, onward and upward. All right, guys, so I've been talking a lot about opportunity cost and the time value of money, and now I'm here with my close friend Kevin Paffrath to discuss these two topics. Kevin, how are you doing?
Doing great. Thanks for having me.
Yeah, glad that you're here with us. And Kevin, can you tell us what it is you do?
Absolutely. So started out as a real estate broker, buying, selling houses. That led to creating a second company, which does construction, designing, and staging.
Awesome. So Kevin, I want to talk to you about opportunity cost specifically. What does that term mean to you, both in your personal life and as an entrepreneur?
Well, as an entrepreneur in personal life, they tend to relate and kind of pull together very quickly. So, what happens with opportunity cost is when my wife Lauren says, "Hey, we should go on a vacation," I go, "I guess that means we're not expanding the business this year." So, that's kind of opportunity cost in my mindset. Is it's really how do I want to live my life when as an entrepreneur, I decide, do I want to spend funds on one thing? I immediately know that I can't spend funds on something else. The same is true in investments, the same as it's true in businesses.
Okay. And so then how do you go about making your decision? So let's say you've got two options in front of you, and how do you know, well, I should go with option A and not option B?
That's very difficult. I love as much as possible to try to evaluate what can I do formulaically. If I could put it on a spreadsheet in terms of buy or lease a car, I could easily figure out the opportunity cost of that. However, when it comes to being a real estate broker where I don't necessarily have very large volume and every little decision could mean very different results, it's difficult to spreadsheet. So what ultimately happens is I spend a lot of time making decisions and seeing how the results come out.
Okay, that's very interesting. So you're saying if you were to have a large volume of, say, real estate sales, you could categorize that by variable and kind of break it down that way. But because you don't, you're limited in that sense. Your scope is limited. And so you kind of have to go with your gut intuition in a way.
100%. I think that's true of almost any small business is that if you're really trying to innovate a marketplace and you're trying to provide a level of service that's different, you don't necessarily know what the client wants yet. So you have to provide these different options. And that might be investing in 10 different options. And all of a sudden you realize, okay, we're canning these 3 and we're going full steam ahead with these 7. You just don't know which it's going to be until you've actually put it out there and the market's responded to you.
Okay, and you're talking about the market responding to you. So how do you evaluate that? Like, how do you know when a choice that you made is actually working?
That's a great question, and it's kind of a very complicated one to answer. But the simplest way is: did sales go up that year, or did sales go down that year? Right? Now, I mean, it could be that seems cut and dry, but realistically, you could have folks come to you and say, Kevin, this is complicated, this is stupid. And you'll get clients that will tell you that to your face. And that's where you can kind of take that kind of feedback from vocal clients and then take that and ask other clients, hey, what did you think? How was your experience with this? And you really have to sort of reverse engineer your opportunity cost.
Okay. Yeah, and so it seems like, Kevin, that your main points here are that you can't calculate opportunity costs for everything. Some things are just intangible. And so do you have a scenario or a situation in which you have calculated something for a tangible case?
Absolutely. I think the best example I could give is when I was working at Red Robin. Before I was a real estate broker, I was working there, and my manager looked at me and said, Kevin, I know you're getting into real estate. I know you want to be a server. That was my dream. I never made it a server. It's terrible. He said, Kevin, you're making $900 a month here. You've got it good. You're on the schedule for 4 shifts this week. Why are you going to go into real estate? You're not going to make it. You're just going to fail, and you'll end up coming right back here. That was where the first thing I did was I went home and opened up a spreadsheet. I go, all right, let's do some present value and future value calculations on $900 versus what I thought I was able to make in real estate. And that was the one time I actually sat down and said, you know what, it's a go. And I left Red Robin based on the spreadsheet.
Wow.
Yeah.
And so earlier I gave an example about going to college or joining the workforce and the opportunity cost of both when you turn 18. What are your thoughts on that?
I love that question because to me, it was definitely one that was at the forefront of my mindset. My father wanted me to go to college. It was a big demand. My thought was, if I'm going to do real estate, I don't need to go to college. So I had this sort of dichotomy of, okay, well, what do I do? Why make an opportunity cost-based decision where I have to decide, okay, I'm going to go black, I'm going to go just real estate, I'm going to go white, I'm just going to go college? Why does it have to be so binary when I can do both? But I was able to get through college. I was able to build a real estate business at the same time to where as soon as college was done, I really felt like this anchor was sort of off my, off me.
Down.
Yeah, exactly. All right, full steam ahead. Let's go.
Great. And I think the big takeaway here, and from what I'm hearing from Kevin, is that don't be weighed down by opportunity costs. Don't be paralyzed because you feel like you're going to lose something. And so opportunity cost is real. It's a real thing. You are going to miss out on one thing if you choose the other, or sometimes you're able to combine the two and then you miss out on something else altogether. But do not be paralyzed by the opportunity cost. Just know that it's there. Before we get going with the heavy-hitting techniques, I will say this. There are many ways to evaluate in which direction you should go with an investment. In this course, I'm going to show you the most common ones that are industry standard and are fairly easy to apply in your own scenarios. If you don't own a business, you should still be aware that these mathematical and logical concepts apply to your daily life. As you continue following along, you'll see what I mean. Here's a sneak peek of what's to come in subsequent chapters. The first technique we'll cover is discounted cash flows, which I'll also call DCF from time to time. It basically just uses cash flow projections and discounts them, fairly analogous to calculating present value using a discount rate. Although the calculations are complex, the purpose of DCF analysis is simply to estimate the money you'd receive from an investment and to adjust for the time value of money. If you already understand the concept of the time value of money, you can probably skip the chapter on DCF. Then we'll build on DCF and look at net present value, commonly referred to as NPV. Net present value is the difference between the value of cash inflows and the present value of cash outflows over a period of time. The result is a single number that gives a good indication of what a business or a particular investment is worth today. The discount rate that most companies use in the NPV calculation is the weighted average cost of capital, or WACC. Many factors influence the calculation of the WACC, which ultimately represents the cost to the business of raising funds. If a project or investment can't earn a return of more than the WACC, the business will be losing money on the investment. The actual calculation of WACC is beyond the scope of this course, but it's important to understand what the number represents. We'll then jump from NPV to IRR, known as the internal rate of return. The IRR is basically the discount rate that sets the NPV equal to 0, and it allows us to see the percentage rate that will be earned for a given set of cash flows. Based off IRR, we can then look at the payback period, which tells us how fast the investors can have their money returned. In conjunction, all these techniques can provide a really nice picture of whether a project is worth investing in. Now that you have a basic idea of how the course is structured, let's dig right into the specifics. You've already met Kevin, the president of 2 successful businesses. Let's imagine that he's in a bit of a situation. Looks like he has some excess money lying around. Hey, good for him. Another business down the road has offered him a private deal, an opportunity to buy a 10% stake in that business. The business has an annual growth rate of about 2.5% per year and is looking to produce about $1 million in free cash flows in the upcoming year. So, if Kevin has a 10% stake in that business, he's looking at $100K in free cash flows next year. What should Kevin pay for that 10% stake? You can maybe even intuitively figure out how to solve this problem. You already know that Kevin's going to have to take several things into account, most importantly, the time value of money. Also, he has to trust the market and the company will continue to perform at the same level over time. So, the technique that Kevin should be using is something called discounted cash flow analysis. The formula for the analysis looks like this. Pretty straightforward, right? Let's break it down so you know exactly what you're looking at. The DCF is a sum of all future discounted cash flows. This is essentially what Kevin is solving for when he looks to determine what his investment amount should be today if the business were to keep up in the future. It's basically the valuation of the business. The CF is a net cash flow for a given year. The subscript represents the year in which the cash flow is calculated. The R is the discount rate, and of course it's in decimal form. Got it? Good. Let's move forward and solve this equation to see what Kevin should pay for this potential investment. I'm going to work out of exercise file 0202 begin. Let's take a look at this lovely discounted cash flows formula again. Okay, so we have to figure out a couple of variables. We've got the cash flows, that's CF. We've got the discount cash flows, which is DCF. And we've got the R, which is the discount rate. So first I want to work on this cash flow for the first 30 years. And you can see I have 30 years mapped out here. So the cash flow for year 1 is simply the $100,000 that we get from the 10% stake in the company. Year 2 is going to be 102.5% of 100,000. How did I get that? Well, I have an annual growth rate of 2.50. So I know that each year, year after year, my money is going to grow by 2.5%. So that's going to be $100,000 times 1.025. So now I have $102,500. Okay, I'm going to do the same thing here for year 3. I'm going to multiply that by 1.025, hit enter, and now I have 105 and some change. And I am going to actually carry this operation all the way down. And the way I did that was I double-clicked the bottom right-hand corner of the cell. This isn't looking too attractive, so let me go ahead and format this using Command 1 under Currency, 0 decimal places, and here we are. And so now I have my cash flows year over year over year. Now let's think about the discount rate. The growth rate of the company is about 2.5%. So what should we set the discount rate as? Well, you have to consider opportunity cost. If we were going to take this extra money and throw it, say, into the stock market, what kind of return would we expect? Because I'm going to keep this discount rate constant, let's imagine that the average stock return rate over 30 years is 7%. So I'm going to go ahead and fill that in here in column C as 0.07. That's 7% average that I'm expecting to get year over year in the stock market. And I'm going to double click the bottom right hand corner of that cell and fill it all the way down for all 30 years. Now let's figure out the discounted cash flow, and this is where the formula comes in. The discounted cash flow is equal to my cash flow, which is $100,000, divided by 1 plus R. Now our R is 0.07, and that's going to stay the same. So I'm going to divide this by 1.07, and I'm going to take it to the first power because this is the first year. And to do that, I am going to click on cell A11. So now, when I press enter, I get a discounted cash flow value of about $93,500. So I want to do the same thing, except remember, the denominator is going to be different for each one. So in this case, the denominator was taken to the first power, year 1. For year 2, it's going to be taken to the second power. So let's do that together just to see what that would look like. So again, that's equals, and that's my cash flow value of $102,500. Now I'm going to divide that by 1.07 to the second power by clicking on A12. I'm going to close parentheses, hit enter, and now I have a value of 89,527. So I'm going to double click that and fill it all the way down, and you'll see that the numerator and the power in the denominator, the exponent in the denominator, correlates with what year we're in. So that worked out really nicely. This doesn't look too pretty for me, so I'm going to scroll down and highlight all the values here and convert them to currency with 0 decimal places. Okay, so now we have our discounted cash flows. Notice a trend here. As you increase the number of years, even though our cash flow increases, our discounted cash flow actually decreases. And that's the opportunity cost and inflation coming into play. So for example, in year 10, you're expected to have a cash flow of $124,886, but that's only worth $63,486 today. And so this should start making sense. Look at year 30. You're supposed to have a cash flow of $204,641 given the growth rate, but given the discount rate, it's only worth $26,883 today. Why? Because the rate that you get in the stock market, that 7% on average, is so much higher than that 2.5% growth rate with the company. And on top of that, it's compounding year over year over year. So think about this. Even though each cash flow has the same interest rate, each one will have a different present value because it's at a different point in time. So there are a couple of ways to look at this. Let me sum up the totals for both of these columns here. So I'm going to click on B42 and type in equals sum. And I'm going to take the sum of B40 all the way up to B11, close the parentheses, and hit enter. So that's almost $4.4 million that you'd get there, supposedly, if you weren't taking the discount rate into account. Now let's take a look. With the discount rate applied, we're going to get a value that's much smaller. Yep, 1.6 million. So look at the difference between these two numbers. So in reality, you're only looking at over 30 years, 1.6 million, given the fact that you can take that money and put it somewhere else that's going to give you a higher revenue. It's time for your next challenge. Let's see if you can calculate how much money should be spent on an investment when given the opportunity. I'm in 0203 Challenge 2 in the exercise files. Let's take a look at our parameters. Imagine that you're offered a rousing 50% stake in a company and you have some extra cash lying around. Or maybe you're looking to do some tax loss harvesting and sell your stocks, whatever the case may be. You think that you'll hold on to the stake for at least 30 years. The company's free cash flows last year were $100,000, but they need funding and they also want your expertise. They're expecting a steady 4% growth year over year for the first 5 years and then 10% steady growth every year after that. After doing some market research, you determined that the discount rate is 12%. What's the maximum amount of money you should pay for this opportunity? This challenge should take you about 5 minutes to complete. Good luck! Let's start the second challenge. So if you want the completed solution spreadsheet, you can find it in the exercise files. It's called 0204 Solution 2. Now, you're asked for a 50% stake in a company that generates free cash flows of about $100,000. That means your free cash flow for that first year is going to be $50,000. So I'm going to go ahead and type that into cell B12. I would like to evaluate all the cash flows for the years first. So I'm going to use the growth rate to do that, which for the first 5 years is 4%. So in cell B13, I can type in equals. And to calculate the cash flow for the second year, I'm simply going to multiply that 50,000 by 1.04. And I'm going to keep doing that for the first 5 years, year over year. And this is actually what we mean by compounding interest. Okay, great. So we've got that down, and the first 5 years, 4%. Now the last 25 years is 10%. So it looks like the company is going to be doing really well for those last 25 years. Good for them. And so to calculate that, in cell B17, I'll type in equals, and my dollar value from year 5, and this time I'm going to multiply it by 1.10, because remember, the growth rate has jumped to 10%. So I'm going to do that there, and then the same thing for year 7. I'm going to take the year 6 rate, multiply it by 1.10, and now I can kind of double-click the bottom right-hand corner of that cell and just make sure that these are being multiplied by 1.1. Great, they are. Now this column doesn't look too pretty, so I'm going to format it to be currency with 0 decimal places. So there we are. And I'm going to scroll back up. Now, what should I set my discount rate to be? Well, I have it right there, 12%. So I don't even have to think about it. So in C12, I can type in 0.12 and just double click that guy all the way down and just make sure that it's covering year 30. Perfect. Now I can calculate the discounted cash flow. And remember, to do this, I'm going to use my formula up here. So that's equal to my numerator, which is $50,000 in cell B12, divided by my discount rate plus 1, so 1.12, and I'm going to take that to the power of the term that it's in. And right now it's in term 1 or year 1, so I'll click on that in cell A12 and close the parentheses. There we are. And just to make sure Excel knows what we're doing, I'll do it for the second year as well. So equals B13 divided by, and I'm putting the parentheses here, and you don't really have to, I'm just doing it kind of out of habit. That's going to be 1.12, and I'm going to take that to the power of year 2 in cell A13. Close off those parentheses, here we are. Let me double click this all the way down, and then of course I'm going to format it. And let me include that first one there as well. Currency with 0 decimals. Okay, here we go. And so what should my maximum bid be? Should it be my cash flow sum at the end of 30 years, or should it be my discounted cash flow sum at the end of 30 years? Well, for me, I'm going to use that discounted cash flow sum because I know that I'm going to be getting a higher percentage back in the market at 12%. So to solve for that, in cell F7, I'll type in the equal sign, and I'm going to take the sum of all my discounted cash flows. Close the parentheses there, hit enter. So this opportunity to me is worth about $855,563. That's the max. If you can get it for cheaper, you should definitely do it. And if you were able to get this on your own, congratulations. I highly recommend that you nail down the concept of discounted cash flows, as it's the basis of the course moving forward. The estimates that you get from DCF are not intended to be a solid number. Regardless, I really like DCF. Why? Well, first and most importantly, it sees that companies may. Creative accounting does exist, but using cash flows tends to attenuate the effect. That being said, there are some downsides to DCF as well. First of all, it doesn't take into account the initial investment that's made. We'll get into that soon. Second, it's very percent year over year. Okay, so I'm back with Kevin, and we're gonna
Figure out, okay, hey,
everyone has time to calculate that.
to return in the market with whatever investments or projects we're doing. Because to me, it's not just a matter of growing businesses, but it's also a matter of investing for future retirement purposes and taking money from today and basically putting it aside for tomorrow. If I think those real estate investments or stock investments or bond investments can yield conservatively, say 6 to 8%, then that's what I'm going to use as my discounted rate.
Okay, so in a way, and this might be going out there. So in a way, the discount rate that you choose is the mathematical opportunity cost for choosing one project over the other.
Bingo.
Okay, that's great. And so, can you give me an example of maybe when you've had to use a discounted cash analysis?
Right. Just to make it very simple, when you get a loan, let's say you can get a 4.5% interest rate, you can now pay money to get a 4% interest rate, or you can get paid money to get a 5% interest rate.
So the bank covers your closing costs or something.
In that case, exactly. Or you could pay more in closing costs. So you kind of have this option, and you want to try to evaluate, well, which option is best for me? In one scenario, I pay more money up front, but over the long run, I save money every single month. In the other scenario, I pay more every month, but I'm saving money up front. That is a perfect example to put a discount rate to use. What do I expect my money can produce today, and is it greater than what I would make if I just saved money on this interest rate?
You got any tips for us? Which way is better?
Well, so the bottom line summary of all of that I've kind of found or I use in my own head is if you're going to keep the loan, not just keep the property because people refinance. If you're going to keep the loan for anything less than 10 years, don't pay points. If anything, get money back, take a higher interest rate. It sounds counterintuitive. Most people don't like doing that, but from a finance point of view, less than 10 years and you're going to refinance or sell, take the highest interest rate. If you're going to live in that property or keep that loan for 15 plus years, get the lowest interest rate possible.
So let me ask you a question because we're talking about opportunity costs and the time value of money here. What if I took the money that the bank gives me, the $5,000 or $10,000 toward closing for a higher interest rate, and what if I invested that in the market instead of using it toward closing costs? Would I then even see a higher return?
I personally think so. I think the money that you save on a residential real estate loan is pennies compared to what you can produce in the market. Realistically, you're saving 4.5% of interest. This is the simple math.
Okay. And so the major takeaway that I'm getting from you, Kevin, is that the discount rate is determined by how the market is doing. How are your other investments doing? How much money are you losing to interest rate that you're paying to banks? And then comparing that discount rate to what your outcome will be over a 10-year period, over a 15-year period. And the time that you spend in the market or in that investment is what governs which project you end up choosing.
100%. A big thing, too, is it's important not to choose an unrealistic discount rate. As much as possible, I try to use 7% just to be, in my mind, conservative in the long run. I don't ever do these analyses for 5 years or 7-year periods. I try to always look, what is my 15, 20, 30-year game plan? And over that course of time, I think 7, 8% very realistic. When people start referring to why not use 10%, I start getting a little nervous.
Okay, because 10% seems a little aggressive.
A little aggressive.
Okay. And so the takeaway here, then, from what I'm hearing is when you're determining time periods, always play the long game with discount rate because time in the market is always more stable than trying to time the market.
That brings up a great real estate quote, too. Don't wait to buy real estate and then wait.
Thanks, Kevin. Net present value, or NPV, is one of the most valuable decision-making metrics you can use to decide whether an investment or project is worth your time or money. NPV builds off the concept of discounted cash flows. Here's a fancy equation with all its Greek symbols and stuff. However, if you strip that down and get to the root of it, it's basically DCF with one extra component. The equation says that you add up all the present values of all future cash inflows and then subtract the sum of the present value of all future cash outflows. These inflows and outflows are simply revenues and costs. What makes NPV so special is that you can continue to calculate NPV over the duration of a lifetime of a project. Obviously, the project's NPV is likely to decrease over time. It has less life and fewer unrealized cash flows because it has already generated that revenue for you. Look at the two equations again for DCF and NPV. To reiterate, NPV is simply DCF less the initial cash investment. Keep this one takeaway in mind that differentiates between these techniques. DCF tells you the present value of the cash flows expected from your model, basically the ongoing cash flow to be generated from your investment. NPV tells you the net return after the accounting of overhead cost. So, if the NPV for a project is positive, that's a good thing. You want to take that investment or project. If it's negative, you probably shouldn't take on that project because you're more than likely going to lose money. I'm putting air quotes around lose money because of opportunity cost. If the NPV on a project is negative, you're more than likely going to get more money out of a project that has a higher NPV or from something like the stock market on average. Any investment will produce a negative NPV if the applied discount rate is high enough. So it makes sense to double check the estimated costs to look for opportunities to economize, to review the sources of revenue, to seek potential enhancements, and to revisit the assumed discount rate. What if the NPV is zero? Remember, NPV is a measure of wealth creation relative to the discount rate. So a negative or zero NPV does not indicate no value. Rather, a zero NPV means that the investment earns a rate of return equal to that of the discount rate. If you discount cash flows using a 6% discount rate and produce a $0 NPV, then the analysis indicates that your investment would earn a 6% rate of return. Alright, enough with all this conceptual stuff. Take a deep breath. Let's dig into the math and do some calculations. Most experts will calculate NPV using a software package. For starters though, let's start with something a little bit different. Remember your takeaway. NPV is DCF calculations less the overhead cost. If we don't have a software package, we can calculate NPV quite easily using net present value tables and annuity tables. These can be found in the exercise files. Basically, these net present value tables tell us the present value for $1 at a certain discount rate at X amount of years down the road. The annuity table tells you the present value of an ordinary annuity at a certain discount rate at X amount of years down the road. They're limited by the number of significant figures, so they're not quite as accurate as financial software, but close enough for our purposes. In case you're wondering, you can think of an annuity as the reverse of present value. For example, take $1. If you're looking at a present value table, the $1 would be discounted further and further as time goes on, simply because that $1 will lose value due to inflation or whatever other factor. An annuity is basically just a series of payments that happens in promised intervals for the same amount. These won't be affected as much by the discount rate because they're not being paid out all at once, but rather in a time series. So you don't lose as much value due to inflation. Let's do a couple of quick examples. Using the present value of one payment table, we can calculate the present value of a singular payment using the discount rate and the amount of time before we receive that payment. Let's say that you're expected to receive $10,000 at the end of 5 years with a discount rate of 5%. On the table, find the intersection of the 5% column with the 5-year row. There, you have a factor of 0.7835. So, to calculate the present value of this $10,000 that's going to be gifted to you in 5 years, you simply need to multiply it by 0.7835. So, you get a present value of $7,835. This is actually no different from using the present value equation I showed in Chapter 1. Analogously, Imagine that I ask you for the present value of annuity payments of $10,000 per year over a 5-year period at a 5% discount rate. You'd find the intersection of 5% column with a row of n equals 5 in the annuity table and find the factor of 4.3295. Then you'd simply multiply the $10,000 by 4.3295 to arrive at the present value of the annuity of $43,295. If you find that you can't solve the present value using the table, let's say for example the discount rate or time period doesn't match your scenario, then you can use the following formula, where PV is the present value, I equals the amount of each annuity payment, R is the interest rate, and N is the number of periods. Let's put these two values side by side. Present value of one future payment and present value of an annuity. Notice the impact of the discount rate is significantly less for the annuity payments. That should make sense at this point. Because you're getting your money in installments, you're literally getting more bang for your buck. Remember, these are just present value calculations. To get net present value, you must subtract your initial cash outflow from these numbers. I'll challenge you to do that next. For this challenge, I'm using exercise file 0303 Challenge 3. What I want you to do is determine whether Kevin's company should invest in a project based on the NPV calculation that you come up with. Imagine that Kevin is buying a piece of machinery for his construction company, Meet and Done. It's a laser alignment machine that gives markings on ceilings for where recessed lighting should be installed. It's quite nifty stuff, really. Anyway, it has an overhead cost of $1,500. Not only that, but it's definitely going to need an upgrade in 5 years, and that's going to cost another $1,000. However, Kevin expects that the piece of machinery will generate net cash flows of about $2,000 per year for the next 10 years. Imagine the discount rate is 8%. According to our handy-dandy table, the present value of $1 for 5 years at 8% is 0.6806. The present value for an ordinary annuity of $1 for 10 years at 8% is 6.7101. Calculate the net present value and decide whether Kevin should invest in this machine based on the projections that he has made. You can totally do this. Think about it in terms of all the cash inflows and outflows. It should take you about 5 minutes. Good luck. If you want to work that solution, feel free to open up exercise file 0304 solution 3. Let's get cracking. If I think about the cash flow stream, I'll be able to figure out if Kevin should invest. So based on the worksheet, I know I have an initial cash outflow of $1,500. So here in cell B13, I'll type in equals and then click on B3. And it's negative because it's an outflow. And to that, I'm going to subtract another value, and that's going to be the upgrade cost. And again, I'm subtracting it because it's going to be a cash outflow. So I'm going to open up parentheses here and click on cell B4, which is the upgrade cost. But I want the present value of that, because remember, that $1,000 is going to be spent 5 years from now. So the present value of that is going to be found by multiplying the $1,000 by the factor 0.6806, which is the present value for $1 5 years from now at an 8% discount rate. And that's going to be in cell B8. I'm going to close those parentheses. And of course, I do have a net cash flow year over year, and that's going to be paid in annuity over the next 10 years. So to get that, I'm going to open up a parentheses, and it's going to be a plus sign. I'm going to add it to this function because it's a positive cash inflow. So I'll click on 2,000 and multiply it by the annuity factor of 6.7101. I'm going to close that and hit enter. And so it looks like I have a net present value of about $11,239. It's a positive net present value, so Kevin should definitely invest in this opportunity. At this point, you may already understand net present value. If you already get how to calculate it, move on with your life and go to the next video. If you need just one more example that's fully worked out, stay tuned. Okay, so here's the gross NPV equation again. And then here's the one that's a bit easier to understand. Let's break down how we can solve for NPV in a few steps. Step 1 is to forecast expected cash flows, What's the initial cost? How long is the project or duration of the investment? What's your estimate for net cash flows per year? Is there an upgrade that's going to cost money in the future? And what do you expect the discount rate to be? Step 2 is to discount all cash flow values to present values using our equation. Step 3 is to calculate the NPV by summing all present values, including the negative initial cost. And last but not least, step 4 is to make a decision on whether to move forward with a project or investment. Okay, let's sketch out a simple scenario. Imagine that Kevin is wondering whether he should invest in a piece of equipment. I'll walk you through the steps. In the first step, he'll have to forecast expected cash flows. The initial cost is going to be the cost of the machine. Let's say that's $5,000. He thinks the machine is going to last him about 7 years and will bring in a positive net cash flow of about $1,000 per year. Let's pretend that there's no upgrade scheduled for this piece of equipment. I want to illustrate the power of the discount rate here. Let's take a look at the math without it. The cost of the machine is $5,000. If you hold the machine for 7 years and it generates $1,000 per year, that's $7,000 over a 7-year period. He should definitely buy the machine, right? Because $7,000 is greater than $5,000. Well, hold on there. We haven't quite accounted for the time value of money by applying a discount rate. He could invest that money in the market instead and potentially make more. So let's slap on that discount rate of 7%, since that's what we imagine we can get in the market over 7 years on average. Step 2. Now we have to discount all the cash flow values back to their present value. Let's do this visually. I'm going to pop up a timeline from time point 0 to time point 7. At year 0, Kevin's making a $5,000 investment, so that present value is simply negative $5,000. It's negative because it's a cash outflow. At time point 1, 1 year later, we'll have to use a present value formula. We have a net cash flow of $1,000, so that goes in the numerator. The denominator is 1 plus the discount rate, which we determined to be 7%, so that's 1.07. We're taking the denominator to the nth power. In this case, n is just 1 because it's the first term. If I run that calculation, I get a present value of $934.58. That's what that $1,000 1 year in the future is worth right now. Okay, let's do the same thing for the second term, year 2. Again, we have a net cash flow of $1,000, so that's in the numerator, 1.07 in the denominator. But this time, we have to raise the denominator to the second power since it's the second term in the timeline in which Kevin's getting paid. Now the present value of that $1,000 2 years down the road is $873.44. I'll go ahead and plug in all the numbers for the rest of the years. Remember, the only thing that's changing is that exponent in the denominator. Now let's do step 3 and solve for NPV by summing up all the values. So that'll be the initial negative $5,000 plus the sum of all the present value calculations. Hey, that's great, but it surely isn't $2,000, is it? That's what we would have gotten if we just taken the numbers at face value, at nominal value, without discounting them. So when we solve for present value, it's quite evident that a little change to the exponent in the denominator makes quite a big difference. Step 4 is to make a decision. Does Kevin take the project or say no? Well, it looks like he's got a positive net present value here. So if he weren't going to look into it any further, he would probably take the project. What's the takeaway here? Consider the time value of money. We did arbitrarily set the discount rate, that's true. However, notice the idea of $7,000 over 7 years isn't exactly $7,000. That, my friends, is the power of time and the way our financial system works based on inflation. Okay, let's move forward. Next, I want to show you how you can quickly pull off these NPV calculations using Excel functions. Let's see how we can quickly solve for NPV in Excel. I'm in the 0306 Begin exercise file. And as you can see, I've set up 2 columns, one for the term and one for the net cash flows. You'll also see that I have a cell for discount rate and another one for net present value. Let's imagine the situation in which our business owner friend Kevin is investing $5,000 for a piece of equipment that he expects to net $1,000 a year for 7 years. The discount rate is 7%, so in cell E4, I'll type in 0.07. And again, I'm solving for NPV. So let's take a look at this table here. My net cash flows for the first year are actually going to be negative $5,000. And why is that? Well, because he invested $5,000. That was a cash outflow. And he expects $1,000 a year in net cash inflow from years 1 to 7. So that's simply going to be a positive $1,000 year over year. I'm going to fill that in. Now, I don't like the way this looks, so I am going to format it. Okay. Now, again, I'm trying to find net present value. So I'm going to actually use the net present value formula. So in cell E5, I'm going to type in an equal sign, NPV, and then that opens up the NPV formula. The rate is 0.07, and my values are simply from cells B3 to B9. This formula does not account for the initial investment, so we actually have to add that in later. So I'm going to type in a plus sign and click on B2 and press enter. So there you have it, a net present value of $389.29. And given the positive NPV, it seems like a pretty good project to take on. Welcome to your fourth challenge. I'm in exercise file 0307 challenge 4. In this challenge, your goal is to determine the net present value using the Excel function in the scenario I'm about to lay out for you. Then, determine if the investment is a good one. Imagine that you have an opportunity to invest in a project that requires an overhead of $10,000. It's a bull market, so the discount rate is 11%. You're expecting the project to go for 10 years and return $1,700 a year in net cash flow. Would you take that project based on net present value? This challenge should take about 5 minutes to complete. Good luck! Alright, welcome to the fourth solution video in this course, and if you want the fully worked out file, you can find it in 0308 Solution 4. So let's take a look at what's going on here. You've got a project overhead of $10,000, and that immediately means that at term equals 0, we have a cash outflow of $10,000. Next, you have a discount rate of 11%, so in cell E2, I'll type in 0.11 to represent the discount rate in decimal form. My project duration is 10 years, that looks good. And I have an annual net return, an annual net cash inflow of $1,700. So I can go ahead and fill that in column B. And I'll double click the bottom right hand corner there. Now, I'm looking for net present value. And to do that, I can use the Excel formula. So I'll type an equal sign, type in NPV, open up the parentheses, and click on cell E2, which is the discount rate, comma. Now, the next argument I'll pass is the cash inflows. Remember, the NPV formula does not account for the cash outflow. So that's B3 through B12, and I will close that. And to that, now I need to add my cash outflow in cell B2, which is a negative $10,000. So when I press enter, I get a net present value of $11.69, and that's a positive net present value for such a high discount rate. I would definitely take this project. Nice job if you're able to get this right. There are definite pros and cons to using net present value to evaluate your investment. Regardless, I would say it's one of the most widely used techniques to figure out if you're going to get the most bang for your buck. Of course, this course just gives you an intro. There's a lot more nuance that goes into it than what I've shown you. So what are the pros? Well, just like discounted cash flows, NPV accounts for the time value of money. As you can recall, a dollar is worth much more now than that same dollar will be in the future, mostly due to inflation and risk. So what are the cons? Well, the big one, which we'll be able to address with another technique, is that NPV doesn't give us visibility into how long it'll take to generate a positive NPV. So our NPV rule tells us to accept all investments where the NPV is greater than 0. However, it doesn't tell us when that positive NPV will be achieved. Will it happen in 5 years? Will it happen in 15 years? Another limitation of the NPV approach, which I'll also address with another technique, is that the model assumes unlimited capital and lack of rationing. If resources are scarce, then you have to look carefully at not just the NPV for each project, but also the size of the investment itself. Again, as I've mentioned repeatedly, NPV really is royalty when it comes to determining whether a project or investment is worth it. I'd much rather that you use this technique instead of going solely on intuition. Next, let's join Kevin in discussing net present value. All right, so I'm back here with Kevin, founder of Meet Kevin and Meet and Done. And this time we're going to talk about net present value. And when I think of net present value, I think immediately of overhead costs, discount rates, right? And so how important is NPV to you and how do you use it in your decision making for business?
Yeah, absolutely. The interesting thing from an entrepreneurial point of view is initially when you first start a business, every NPV calc you run is negative and it's very depressing. So ultimately, I kind of just don't. But when it becomes very important is when you start developing your business and now you have to decide between options within your business. Do we buy another sprinter van? Do we expand the business with different tools? Do we buy a concrete mixer? Where do we want to spend? Where do we think we're going to get a better yield? But also in terms of where do we want to invest business profits? That's where NPV is really going to be a killer, where at the very least you want that to be zero to match your discount rate. But ideally, as long as if you're learning, zero is okay, but if you're doing zero and you keep doing zero, something's wrong, all right? You want that to be positive, so it is a good formula to run.
So just a little comfort to our budding entrepreneurs. Why is it so negative at the beginning? Is it because you're buying a lot of depreciating assets? Why was it typically negative at the beginning?
It's multiple ways of looking at it. First of all, when you hire an attorney to set up two corporations, you make zero on that. When you hire a company to set up interviews for you or payroll or workers' comp, you make zero on that. Those are what I call unproductive expenditures. What is productive to me is hiring somebody that is going to hang drywall for me. I can immediately find out, okay, if we spend this on labor and this on material, we will net this. Now I can use the formulas. But when I'm building a brand and I'm trying to build something based on a new type of customer service, I can't evaluate that on a spreadsheet yet.
Yeah. And, I think when I think of NPV, and I'm not an entrepreneur, but when I think of NPV, I do make real estate investments. Right. And to me, the huge question is, do I put 20% down on a house? And I think that's a great NPV discussion, right? And so what's your take on that? Because I know that you don't have to put down 20% to people out there that are in the market for a home. I think that's a common misconception that you don't need to put down 20%. You can put down as little as 3% for a conventional loan if you can qualify for the loan amount of the purchase price. So you can control a $500,000 property for $15,000 down plus closing costs. But that's besides the point. That's leverage and completely different. But what is your take on that? Like, do you put down 20%? Do you put down 10%, 3%? How do you determine what you should put down?
Exactly. That is where take that aggressive point of view, I love putting down as little as I can on a house that I'm going to live in. That's sort of the caveat is you can only put down less than 20% if you're going to live in the house.
Owner occupied.
So if you owner occupy the house, you could put 5% down, you could put 20% down. If I have the 20%, I would rather put 5% down on the house, have a little bit higher of an interest rate in the form of private mortgage insurance or PMI, take that extra 15%, throw it into a business, and I'm going to make way more money in a business, at least at this point, than I will by saving money on interest on a loan or private mortgage insurance.
And so how does NPV play into that? Let's put that in terms of the math of NPV. How does that quite fit in?
Absolutely. Well, to me, what's so interesting about running a business is that you could calculate out with a discount rate of 8, you could calculate out that this is a great decision. I'm going to make 2 times my money back in 7 years or whatever it is using formulas. But I can also flip that and say, well, if I put $15,000 or $150,000 or whatever it is into a business, I might be able to turn that into 5 times, 10 times the original investment. And it's because money goes a lot further in a new business than from an investment point of view. So if you're deciding between a business that you're currently operating and making an investment in, say, real estate, stocks, or bonds, oftentimes a successful business will return a lot more.
That's very interesting and very helpful to know information. Thanks a lot, Kevin. So I think when we think about net present value, you have to, of course, calculate that overhead cost, being the down payment, being the closing costs, being the mortgage insurance. And then you have to kind of plan out, what do I expect my net profit to be, my net cash flow year over year over year, term over term over term. And then comparing that with the discount rate and seeing what projects you have and what the opportunities are with each project, you can then make a data-informed decision and pick the right project for you. Yes, NPV is awesome. However, there are also some other common measures that are used alongside NPV to determine whether an investment or project will be worth your time and money. The first one I want to show you is the internal rate of return, lovingly known as IRR. The IRR is a discount rate that sets the NPV of a project equal to 0. It allows us to see the percentage rate that will be earned for a given set of cash flows. This method incorporates the time value of money, just like the NPV. It's often used when there's a lack of clarity or consensus within the company as to what discount rate should be used in the NPV calculation. So again, IRR is a discount rate that sets NPV equal to 0. When our net present value is 0, we'll know that we'll get at least as high a return as our discount rate. So, if the IRR is set at a desirable percentage, and we get a positive or 0 NPV, then we know that the project is probably a good investment. It's generally considered a good practice to consider both the NPV and the IRR when deciding whether to invest in a project. Notice how NPV and IRR are different. With NPV, we've predetermined the discount rate and are checking to see if the net present value of future cash flows is acceptable. With IRR, we're trying to determine the discount rate when we have an NPV of 0, and then comparing that calculated discount rate to the suggested real-world discount rate. So, I'll start by showing you how to calculate IRR by hand in Excel using the NPV formula. Then, I'll show you the easy way using a simple Excel function. Let's get going. Okay, remember, IRR, or internal rate of return, is simply the discount rate that, when applied to a project's expected cash flow yield, results in an NPV of 0. Take a look at the simple NPV formula again. When we're solving for IRR, we're simply solving for that lowercase r. Remember, we have to get the NPV equal to 0. So when we solve this thing by hand, we have to fine-tune it until we get it just right. What I mean by that is that we'll have to just plug in discount rates to figure out which one will bring the NPV closest to 0. I think the best way to show this is just to do an example with our good buddy Kevin. Let's imagine that Kevin is about to do a major renovation on a subdivision of homes. To get the machinery and the materials that he needs, he's going to drop $1 million. So, at time 0, he has a negative cash flow of $1 million. Now, instead of getting one lump sum payment, he's worked out an agreement with the client to get paid annually over the next 4 years. He's going to get paid $400K every single year. So the question becomes, what does the discount rate have to be for Kevin to take on this project? Well, let's look at the generic NPV formula again and plug in our numbers. Okay, to get NPV equal to 0, we'll have to see what the discount rate should be. So start plugging in numbers for the denominator values for each given time. So let's start with a rate of 10% first. That changes the denominator term to 1.10. With that discount, I get an NPV of $267,946. This is way too high. Remember, we want it to be around 0. Let me try 25%. So the denominator is now 1.25. The resulting NPV from that is negative $55,360, and that's a bit too low. Remember, we want to get close to 0. So you get the point. You keep going back and forth and narrowing the range. In this case, I've already done the math, and I know the discount rate is somewhere between 21 and 22%. That's when the NPV switches from being positive to negative, so it crosses over 0. If I want to get really specific, I can use more significant figures, so it's 21.862269%. Most people aren't going to take it that far. So, that's Kevin's internal rate of return. Now he needs to compare that to the actual discount rate he would actually use. Given inflation and all that jazz, he probably figures the discount rate is closer to 10% for this project. Since the IRR is much higher than the estimated discount rate, he should probably accept the project. If it were to be lower than the estimated discount rate, he would have to reject the project because he can get a better return on his investment elsewhere. This rule is guaranteed if and only if all the negative cash flows occur before the positive cash flows. In this case, Kevin spent the $1 million before he got any positive cash flow, so it works out. If Kevin were doing multiple projects, he would choose the one that has the highest internal rate of return. And this may seem fairly straightforward, but there may be situations that aren't quite so seamless. Let's take a look at those next. consider the following scenario. Kevin's construction company, Meat and Done, is considering taking on quite a large project. The deal is for $30 million paid out over a 5-year period. However, the payout is structured so that Kevin will receive $10 million upfront at time 0, and then receive the other $20 million at the end of year 5. Let's further imagine that Kevin is going to incur costs of about $6 million per year over the next 4 years to even complete the project. We'll go with a discount rate of 10% on all future cash flows throughout the project. Just from looking at this, without considering the time value of money, we can imagine that Kevin's getting a good deal. After all, his costs are $24 million, and he's getting paid $30 million for a profit of $6 million. So let's put this on a timeline just to see what it would look like. Starting with time 0, Kevin has a payment coming to him of $10 million. Then from times 1 through 4, Kevin's losing $6 million per year. Again, without considering the time value of money, we can say that he's actually down after year 2 with a loss of $2 million. I keep pointing this out because, well, quite frankly, I want to drill it into your head. Always consider the time value of money. Okay, then in year 5, he's going to get another payout of $20 million, which is a positive cash flow. So notice the pattern here. He's getting a positive, then a negative, and then a positive cash flow again. If I shove all these numbers into a software program and ask for an IRR value, I get an error. There's no way to calculate this because it breaks our golden rule of IRR. In this case, Kevin will simply have to go off the NPV calculation. Okay, next, let's look at a scenario in which there's more than one internal rate of return. I'm going to show you a bit of a strange scenario in which you should also ignore IRR. A quick warning ahead of time. This is going to get really math intensive, and I'm going to show you how to do it by hand. It's much easier just to do it in Excel. If you like math, keep watching. Otherwise, pass on this video and move on. Are you still hanging on? Okay. Feel free to pause and take notes as you please. It took me a couple of times to get this concept when I first started, so rewatch as much as you need. Multiple IRRs generally happen when there's a sign change from a negative to a positive and then back to a negative on the timeline. Let's set the scenario, and this is purely hypothetical, so you'll have to stretch your imagination a bit. Now, suppose that Kevin is taking on a restoration project. At first, he's going to drop $3.2 million to renovate a beautiful Venetian mansion. Okay, so that's a negative cash flow of $3.2 million at time 0. Now, when he sells it at time 1, he's going to expect to make $20 million. But then he's later informed that the mansion is a historical artifact, and he's going to have to undo all of his renovations, so he'll have to drop another $20 million at time 2. Now, this is quite unfortunate for Kevin, and super unrealistic because he's a lot smarter than that. But it is what it is for the sake of this example. What we want to do is calculate the IRR in this case. So, recall that net present value needs to be set to 0 when you're trying to solve for IRR, which in this case would be essentially the discount rate. The NPV is then set to the initial investment plus present value at time 1 plus the present value at time 2. Using the discount cash flows formula of net cash flow divided by 1 plus r to the nth power, we get this formula, which is simply 0 equals negative 3.2 million plus 20 million divided by 1 plus r to the first power minus 20 million divided by 1 plus r to the second power. The sign before each term shows whether the net cash flow was positive or negative for that particular time period. Now I'll need to add 3.2 million to both sides. So I'm left with a common numerator of 20 million on both sides, so I can bring that out front and multiply by the remaining quantity. So I'll get 3.2 million equals 20 million times this quantity. To keep things simple, I'll cancel out the zeros to get 32 equals 200 times this quantity. Now I'll divide both sides by 200 and simplify to get this. Let's simplify the right side of the equation to 1 plus r minus 1 divided by 1 plus r squared. The 1's will cancel out to leave r divided by 1 plus r to the second on the right-hand side. This leaves the equation 4 divided by 25 equals r divided by 1 plus r squared. Now we can cross multiply to get 4 times 1 plus r to the second equals 25r. Let's expand the 1 plus r squared term by using the property a plus b squared is the same as a squared plus 2ab plus b squared. So, applying that, we get an equation that looks like this. Then, I can multiply out the 4 and get this. So now let's rearrange and combine to make this thing look like a quadratic. We've got 4r squared minus 17r plus 4 equals 0. To remind you, the generic quadratic function is ax squared plus bx plus c. So in this case, x is equal to r, a equals 4, b equals negative 17, and c equals 4. Now you have to solve for the two possible solutions of x using the formula x equals negative b plus or minus the square root of b squared minus 4ac all divided by 2a. So plug in the numbers as such, and solve. If you don't feel like doing the math, there are a ton of calculators that'll do it for you. I'm going to skip a couple of algebraic steps here and get to 17 plus or minus 15 all divided by 8. So now you have two answers. You've got 17 plus 15 divided by 8, and you have 17 minus 15 divided by 8. That leaves us with either 32 divided by 8 or 2 divided by 8. 32 divided by 8 equals 4, so that's one answer for r. And the other answer for r is 2 divided by 8, or 0.25. Now, these are both in decimal form and need to be converted to percentages. So multiply both by 100 to get an IRR of either 400% or 25%. So these answers are pretty far apart. Truthfully, the real IRR may lie somewhere in the middle, but it's hard to tell. We'd have to use net present value to figure out what the actual discount rate might be, or we can simply say that IRR is close to 25%, which seems like the more reasonable option. Okay, that was tough, I know. Next, let me show you how to do IRR calculations in Excel. I think you'll find it to be much easier. Let's see how to do the IRR calculations in Excel. I'm going to be working out of the 0405 Begin exercise file. Let's start with the simple IRR calculation. I'm in the Simple tab of this worksheet. I want to use the data from a previous video here. Recall that Kevin needs to spend $1 million before even starting his project, and he has a negative cash initial outflow for that amount. To refresh your memory, Kevin is a business owner that has been the example decision maker throughout the course. So he has 4 terms in which he's receiving $400,000 each, so that's a positive cash inflow. I'm going to assume a discount rate of 8%. Not sure if that's correct, but let's just have it as a placeholder, and that 8% rate is fairly standard. Now I'll solve for the IRR by using the built-in IRR function in cell E5. So I'll type in an equal sign, open up IRR, and this takes 2 arguments. One is just a value, so I'll highlight from B4 to B8, and the next is a guess. So I can kind of take a guess at what the internal rate of return actually is. This doesn't prove to be too useful when you're using simple calculations, but I'll show you how it comes into play a little bit later on. And so let me just get rid of that comma, close out the parentheses. Looks like I have an IRR of about 22%. So I want to be a little more precise than this, so I'm going to open up a couple of decimal places here, and we get to 21.862. That's fine. And just for practice, let's also figure out our net present value. So that's equal to NPV, open parenthesis. My rate is 8%. My values are from terms 1 through 4. And to that, I'll add my negative cash outflow. So my net present value is about $325,000. So this project is actually looking really good. So let's think about what the IRR means again. The IRR is the percentage, is the discount rate that sets the NPV equal to 0. And because our IRR is so much higher than our discount rate, we should definitely accept this project. And it makes sense that the net present value then is a resulting large positive number. Okay, let's skip over to a more complex scenario with multiple IRRs. Same exercise file, but this time I'm in the multiple tab. And let me zoom into 160% so you can see. In this scenario, Kevin has an initial expenditure of $3.2 million, then a positive net cash flow of $20 million in the first term, and a negative cash flow of $20 million in the second term. In this case, there are 2 sign changes, notice, from term 0 to term 1 and from term 1 to term 2. That alerts me that I actually may have multiple internal rates of return. So I'm going to set this up a little bit differently. I'm going to have 4 discount rate spots in rows 11 through 14 simply as placeholders. I like to use a minimal 1% and then something obnoxious like 999%, so that we can capture all the possible internal rates of return. Okay, so let's work this out. I'm going to calculate the first IRR in cell C11. So that's going to be an equal IRR, and my values are from B4 through B6, and I need to use those as absolute cell references, so that's Command T, and my guess is going to be 1%. Again, I'm only using the guesses because I have more than one IRR. I'll close that out, hit enter. So great, there's the calculation of 25%. So now I'm going to double click this and look at what happens. Because I guessed that my discount rate is between 25% and 999%, my second IRR was exposed at 400%. When you have two values like this, it may be prudent just to calculate the net present value for the different discount rates instead. So I'll do that. I'll define discount rates in increments of 3 ranging from 1% to 30% in cells F3 through F13. Then I'll calculate the corresponding net present values in cells G3 through G13. So let's start in cell G3, and that's equal to NPV, open parenthesis, my rate is going to be 1%. My values are these two, B5 and B6, and I'm going to reference those because those aren't going to be changing. And to that, I'm going to add my term 0, my negative cash outflow, and I also need to make that a standard cell reference because that's not changing either. Hit enter, and I'm getting a percentage here, and that's not right. So let me go ahead and shift these over to currency, and I'm going to add a $ in front. Hit OK. So you can see that I have a negative net present value there. So if my discount rate were to be 1%, that would not be good. But let's see what happens when I take it out to 30%. Notice that between 24% and 27%, the sign changes from negative to positive. And that makes a lot of sense, right? Because we've calculated an internal rate of return of 25%. That's where the NPV is going to be 0. So once you get past the 25%, you're going to start seeing a positive NPV. Okay, so what about that 400% that we calculated? Well, let's do this. Why don't we extend these out all the way to 400%? Okay, so I've set it at 402%. I'm going to come back up here, all the way back to my 30% mark, and double click and refill all of these. Check it out. So now we get positive, 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 positive. We have all these positive NPVs. Now, all of a sudden, right around here, 231 to 234, we've got a point of inflection. And now we're decreasing, and we're decreasing, and we're decreasing. And bam, right here, right between 399 and 402, we've crossed over that $0 NPV mark, and now we're back in the negative. So that's why there are two IRRs there. At a certain point, a high enough IRR will reset the NPV to 0. So that's pretty cool. You have to take that into consideration. So if you're really wondering what the discount rate needs to be to get the highest net present value, it's actually right here, 99%, the 1.799 million. So it's pretty cool. And you can figure out what the multiple IRRs are using Excel quite easily. Welcome to your 5th challenge in this course. In this challenge, your job is to determine the IRR and NPV and whether Kevin should accept the project that has been presented. It should take you less than 10 minutes to complete this challenge. There are 2 parts to this challenge, simple and multiple. In the exercise file labeled 0406 Challenge 5, in the Simple tab, imagine that Kevin has a potential project in which he has to initially invest $1 million. The project takes 10 years and it's estimated to produce a net cash flow of $125,000 a year. The discount rate is assumed to be 5%. Calculate the IRR and NPV of this project. Is it worth Kevin's time to take it on? Okay, now for the second part of the challenge. Let's take a look at the Multiple tab. This time, I provided the net cash flows. See if you can determine the 2 different IRR values. It should take you less than 5 minutes to complete this challenge. Good luck! Let's crack through this challenge here. If you want the fully worked out file, take a look at 0407 Solution 5 from the exercise files. All right, let's start with a Simple tab. And right here in cell E4, my assumed discount rate is 0.05, so I'm going to type that in. My internal rate of return, I can't do anything about that yet. So
we need to figure out what the net cash flows actually are. I have an initial overhead of 1 million, so that's automatically negative 1 million in time 0. And then I have a duration of 10 years, so that looks right. And my annual cash flows are $125,000. So let me go ahead and put in that information in cell B5. And then I'll double click and autofill the rest. To calculate the IRR in cell E5, I simply type in the equal sign, type up IRR and open the parentheses, and take in all the values from B4 to B14, close the parentheses, hit enter. My IRR is 4%. Now let's figure out what the net present value is. So the NPV is equal to NPV, open parentheses, my rate, my discount rate is 5%. And I'm going to take in all the values from B5 through B14, close that out, and to that, I'll add my negative cash outflow at term 0. Hit enter, and it's going to give me a really ugly number, but I could fix that with 0 decimal places. Press OK. So let's take a look at what happened here. We've got a negative net present value, and we've got an internal rate of return that's actually less than the discount rate, which means that if you were to take your money elsewhere that got a 5% discount rate, you would probably get a better deal. So should this project be taken on? No, probably not. Okay, so let's take a look at the multiple and see what happens. So over in the multiple tab, you should notice immediately there are 2 sign changes in the net cash flows over the 5-year term. So you should be expecting 2 internal rate of return values. So let's figure that out. I'll assume some discount rates in column D. Let's go with 1%, 15%, 50%, and 999%. Looks like there was some kind of error here, so let me get rid of that other percentage sign. Now I can calculate the internal rate of return. So in cell C14, I'll type in equals IRR, and my values are all the values from B4 to B9. I'm going to use those as standard references. And my guess is simply going to be the 1% that I entered over in column D in the correlating row. Close out those parentheses, hit enter. Looks like I have one IRR of 15%. That's awesome. So now let me double click that. And even at 999%, I'm not finding out what my second IRR is. And that's kind of an issue. So we don't necessarily have to know what the second IRR is. More than likely, we're just going to use this 15% value. Well, let's just see. If I type in 2,000, I'm not getting it. 5,000, I'm not getting it. 6,000, finally. So right around a discount rate of 6,000%, somewhere between 5,000 and 6,000%, we have another point of inflection and another IRR. So in any case, we're probably imagining that Kevin is okay with a 15% IRR, and he'll have to just calculate the NPV to see if the project is actually worth his investment.
I really like IRR for its simplicity, at least when the project investment structure is simple. There are no difficult formulas, and it gives a really good metric that you can compare against other projects that you're considering. I also like it because it ignores a lot of the guessing. For example, you don't have to worry about what the WACC discount rate is. So the risk of calculating it is immediately mitigated. Of course, I also love that IRR takes into account the time value of money, which results in each cash flow being given an equal weight. However, its simplicity also limits its scope. For example, there's no parameter for the size of the project. A project with a $100,000 overhead cost and projected cash flows of $25,000 in the next 5 years has an IRR of 7.94%, whereas a project with a $10,000 overhead and projected cash flows of $3,000 in the next 5 years has an IRR of 15.2%. Using the IRR method alone makes the second, smaller project more attractive and ignores the fact that the larger project can generate significantly higher cash flows and perhaps larger profits. So, every method comes with its pros and cons. I find it best to use NPV and IRR in conjunction to make an evaluation. I'm going to show you one more method that you might want to consider. The payback period is simply the amount of time it takes to get your money back. It's another helpful metric that you can use to guide whether you choose to take on a specific project. I want to be clear from the get-go that the payback period breaks my cardinal rule and my heart and absolutely ignores the time value of money. You should definitely look at DCF, NPV, and IRR as the headliners, and the payback period as the starting act. Another way to think about the payback period is that it's the break-even point, or the point at which positive cash flows and negative cash flows incurred to date net to zero. By calculating the cumulative cash flows, it's easy to see when the cash flows flip from being negative to being positive. If it doesn't flip exactly at a certain year, then you just need to find the portion of the following year that it takes to recover the remaining cash outlay. I also want to make a quick note here. I'm assuming continuous cash flow throughout the year. I'm not assuming a payout at the beginning of each year. Let's see how this may work. Imagine that our good friend Kevin is considering buying a machine that costs $8,000. It'll generate net revenues of $2,000 for the next 4 years and then $1,000 for 4 years after that. How long will it take Kevin to recover his money? Let's look at all the money in terms of net cash flows and cumulative cash flows. I've shown them as two different columns here. At time 0, Kevin will have to make an initial investment of $8,000, so both the net and cumulative cash flows will be negative $8,000. Then at T1, or in year 1, Kevin will make a net $2,000, so the cumulative goes to negative $6,000. Then at T2, Kevin makes another $2,000, so the cumulative goes to negative $4,000. Let's continue this trend so you can see what the payout looks like. You see where the cumulative hits 0 at the end of year 4? That's the pay period threshold. After 4 years, Kevin will have broken even on his investment. Remember, that's completely disregarding the time value of money. I chose an easy example to illustrate a point. Most of the time, it's not that cute and fun. To look at something a bit more complex, let's jump into a spreadsheet.
Let's use Microsoft Excel to calculate the payback period. I'm in exercise file 0410 begin. So take a look at the problem that our business owner friend Kevin is facing. He wants to figure out his payback period. And so you'll see that he's got an overhead cost of $7,000, some net revenue numbers, and he's like, when am I going to get my money back? So you'll see that in Excel, I have two distinct rows here, net cash flow and cumulative cash flow. And I'm going to need to figure those out to figure out my payback period. So let's work on net cash flow first. At term 0, I've got a negative $7,000, right? That's the overhead cost. It's always going to be negative. So let me go ahead and type that in. In the first 3 years, I have $1,500 worth of revenue, so I can actually type in those numbers as well. Look at how easy this is. We've already figured out a bunch. Now, in the next 5 years, I've got only $1,000 of cash flow, so I'll type in those numbers and autofill the rest. Great. Now I've got to figure out the cumulative cash flow. How much money am I left with at the end of each term? So to do this mathematically in Excel, I'll use the sum function. So I'll type in equals sum. And I'm going to take my number B2, and I'm actually going to standardize it, use it as a standard cell reference by pressing Command T, and I'm going to take the sum of that number to that number, B2. So when I close those parentheses, I get a negative $7,000. Now, if I am to double click here and take it all the way down, it's going to autofill that formula, but each time it's going to do it for the number that's in a different row for that net cash flow column. And so let me reformat this, Command 1, and I'm going to put it in currency, 0 decimal places. And so here we have it. So how do we figure out the payback period here? Well, we know that we go from negative to positive in term 6. So between term 5 and term 6, right? And we're assuming that all this money is coming at the end of each term. So in the payback period calculation, I can simply say, well, that's equal to my payback period before I change signs, that's 5, minus a ratio. And this ratio is simply going to be what I have in cumulative cash flow for that year, for that term, divided by what I'm expecting to get net cash flow the next term. So that's going to be B8. Let me close that parentheses, and there I have it. I have a payback period of 5.5 years.
Welcome to your 6th and final challenge in this course. In this challenge, I'll present to you a set of data for 2 different projects, which you can find in exercise file 0411, challenge 6. From the set of data, you'll need to determine the NPV, IRR, and payback period for each project. After that, determine whether you'd accept each project on its own. Then, determine which of the projects you would choose between the two. The challenge should take approximately 5 minutes. Good luck!
We're on our very last challenge of the course, and this is kind of the culminating project, if you will. And if you just want the fully worked out exercise file, you can take a look at 0412 Solution 6 from the exercise files. And this is just so much fun. Let's take a look at these two projects. We have two projects to choose from, and we're going to see if these are both acceptable projects on their own and which one we would pick if we had to choose one or the other. So I've shown you the net cash flow, I've shown you the net cash flow of project 2 here, and I've shown you the net sum. Notice how the net sum, at the end of the day, if you look at the bottom line after 7 years, your net sum is the exact same. But I'm going to show you that these projects themselves are not the same. So let's calculate the NPV, IRR, payback period individually for each project. You already know how to do NPV, so in cell F6 equals NPV open parenthesis, my rate is 6%, and my values are from B5 to B11. I'm going to close that off, and then to that I'll add my negative $200,000. Bam. Now I'm going to reformat that to currency with 2 decimal places. Press OK. And I have a NPV of 63,198. That looks terrific. Let me see what my IRR looks like. So for IRR, I'll just use equals IRR in cell F7 and ingest all these values for all 7 terms plus the initial investment. Hit enter. 13% IRR. Hey, we're looking really good. So positive NPV, got an internal rate of return that's higher than discount rate. Let's figure out the payback period. To do that, we're going to have to figure out the cumulative cash flow. So that's equal to the sum of B4, and I'm going to standard cell reference that, to B4, close parentheses, and then I'm going to fill that down. But I want to make sure I don't get the net sum in there as well, so I'll drag it down. Hey, this is easy. Looks like we have a cumulative cash flow of 0, so our payback period is actually just 5 years. So do we accept this project? Yeah, of course. We've got a pretty short payback period. We've got a high IRR that's higher than our discount rate. We've got a high NPV. So yes, absolutely accept this project. Let's take a look at project 2. Same discount rate, right? Same discount rate, same net sum, but let's see how this one is different. So I'm going to type in equals NPV here in cell F19. My rate is 6%. I'm going to ingest these arguments here from B18 to B24. And to that, I'll add my term 0, negative cash outflow. Look at that, 89,000 versus 63,000. It gets better. So in cell F20, I'll type in equals IRR, and I'm going to ingest all these values from B17 to B24, press enter, 23% internal rate of return versus a 13% internal rate of return. Why could that be? Our discount rate is the same. Our net sum is the same. Let's keep thinking. So now I need payback period. So I'm going to calculate cumulative cash flow again, standardizing cell B17 to cell B17. Drag that down. And now to calculate the payback period, I'll have to take equals. Where does the sign turn negative? From negative to positive? Right after year 2, so A19. From that, I'll subtract the ratio of the cumulative cash flow at A19, or at term 2, which is 20,000, divided by my expected net cash flow at the next term, which is 60,000, or cell B20. Close that off. Looks like I have a payback period of 2.33 years versus 5 years. So do I accept this project? Of course. Individually, yes. IRR is higher than discount rate by almost 4 times. Net present value is enormous. We're getting our money back so much faster. Why are these two projects so different? Well, because it depends on when you get your money. In project 1, we're getting the bulk of our money at year 7 at $100,000. In project 2, we're getting the bulk of our money at year 1. We're getting all that money back at year 1. And all that money can then be reinvested or put somewhere else where you can get a higher return. And that is the biggest difference. When you get your money back matters. So which one do you choose? If you're presented with these two, project 1 and project 2, which one do you choose? Of course you choose project 2. It's got such better payback period, such higher IRR, such higher NPV, that it's definitely worth it over project 1. And this is why the time value of money is so powerful. These two projects may look identical from a bird's eye view, but When you get your money back matters, and that's why Project 2 is such a better choice if you have to choose